You probably know that investing is key for financial security, but for a lot of people, it can feel overwhelming to get started. I know it did for me, which is why it took me forever to get started with investing. But don't worry, in this video, I'm going to cover 3 ways that you can officially start investing with a small amount, like $300. Only your money is going to be real and it's not fake movie money. And because I care about you, I'm also going to cover a few things that you got to do to ensure that you have the best possible chance of being successful at investing. So if you watch this entire video, you pick one of these 3 methods and you follow the steps, you'll be able to consider yourself an investor. Sound like a plan? For those new here, hello and welcome. My name is Lissa and I'm an accredited financial counselor who didn't learn much about investing until my 30s. Now I'm a personal finance expert who wants to see more women of color winning in life. Now FYI, before y'all come at me like y'all tend to do in the comments, anyone is welcome here. We are a community of winners who want to build wealth. I just need my fellow women of color to know that wealth is possible for us, and we've historically been excluded from the conversation, so this is a safe space for you. Now, spoiler alert, I'm going to explain to you 3 methods of how to get started with investing with just a few $100s. However, I will not be telling you which exact securities or stocks to buy. As an accredited financial counselor, I am bound by ethics to educate, but I cannot tell you exactly where to put your money and what to purchase because number 1, I don't have a securities license, and 2, even if I did, I can't really give personalized recommendations on the internet because I'm talking to a bunch of you and I don't know your personal situation. So with all that said, just be careful out there on the internet because not all financial experts or financial advice can be trusted. So investing is very important for building wealth. Why do we want to build wealth? Obviously, because wealth allows us to have more security, more experiences, more access, and more options in life. In short, wealth can mean a better quality of life. It's not about greed, it's not about being selfish, but wealth can actually bring us a better quality of life. So there's no question that you should start investing at some point in life if you want a better quality of life. The question is, when should you start investing? Now, there is not an exact age that is the best time to start. In theory, you want to start investing as soon as possible because a longer time horizon, meaning your money is invested for a long time, that is the magic sauce to growing your money. Plus, the longer you stay invested, the less risky it becomes and the higher likelihood that you are going to make money, not just a little bit, but exponentially over time. So yes, as soon as possible is important. However, there are a few bases that you want to make sure you cover before you start investing. Because if you don't, you might risk taking your money out too early or at a time that doesn't make sense financially if the markets are down. If you're new to investing or you're new to personal finance in general, I just want you to know that it's about having a solid strategy. Before I talk through those 3 ways that you can start investing with just a few $100s, I want to quickly cover 4 things you should do before you start investing. Doing these things are going to ensure that you're not taking 2 steps forward, 5 steps backwards, and then back to square one or even worse. You don't want to take the leap to invest until you have that cushion to fall back on. So you can kind of consider these 4 things investing prerequisites. Number 1, have an emergency fund. Whether it's a starter emergency fund of $1,000 or $1,500, or you have 1 month's worth of expenses saved up, or maybe even 3 to 6 months worth of expenses, just make sure that you have money set aside for emergencies. Investing does not work out if you have to pull money out when it's out of your control. Because if the market is down and your overall investment portfolio is down, you will realize your loss. You will actually make that loss real. On top of that, if you have not held your investment for more than a year, you might end up paying more in taxes. If you want to learn more about building your emergency fund, make sure you check out this video up here. All right, number 2, something to do before you start investing is to pay off your high interest debt. Remember that making gains on your investments are not a for sure thing. So over time, it's likely that you're gonna make gains, but it's never 100% that that's gonna happen. Now, if you have debt, and specifically high interest debt, that is a for sure cost. That is a for sure loss of money. So you want to make sure that you pay off your high interest debt before you dedicate money towards investing. Otherwise, it usually doesn't make financial sense. Number 3, understand your risk tolerance. Essentially, how much risk are you willing to take financially and even mentally and emotionally with your money? Generally, the higher risk you're willing to take, the higher potential reward. The lower risk you take, the lower potential reward. You can still make money, but it might not be as much. The reason you need to know your own risk tolerance is because this is going to help you determine your investment strategy. What to buy, when to buy it, how long to stay in the market, etc. Now, quick side note. One reason that it's low-key unethical for YouTubers or random people on the internet to tell you exactly what to invest in is because they don't know your risk tolerance. And like I said, your risk tolerance determines your strategy, which is going to include what you invest in. And this matters at the end of the day because it is your money on the line. Number 4, the last thing that I personally think you should do before you start investing is to learn the basics of investing, or at least commit to learning more about it. Now, I'm not saying you have to know everything about investing before you get started, but even when you do start investing, just don't stop there. Keep learning because it's going to give you more confidence about investing in general, and it's going to motivate you to stick to your investing strategy and your plan. Sidebar, if investing is something that has never made sense to you, then check out this video up here and hopefully it can help you start to grasp the concept a little bit better. All right, almost to the part of the video that you actually came for, but real quick, if you have learned anything so far in this video, please hit the like button and make sure you subscribe because it'll help out my channel a lot. Finally, we are at the part of the video that you probably came for. How can you start investing as a beginner with as little as $300? Oh wait, oh my God, wait. My bad. I have one more piece of advice about investing before you start. I know, I'm talking too much, but this is important. If this is your very first time investing, make sure that you start with an amount that you do not need and that you are mentally okay with losing. Now, you're most likely not going to lose your money, but having this mindset going into it for your first time is going to ease you into investing with little stress, and less stress is the way to go. All right, here are 3 ways to get started with investing. Number 1, an employer-sponsored retirement account. Contribute to your employer-sponsored retirement account, such as your 401k or your 403b. Not everyone is going to have this option because it's going to depend on your job, and these 2 accounts are actually specific to people based in the United States. However, it is one way that you can start investing with a small amount. So if you have one of these accounts at your job as an employee benefit and you contribute money to it out of your paycheck, guess what? You are already an investor. So here's kind of how it works. First, you get hired with an employer who sponsors your retirement account, and sometimes you have to opt in. Second, you create your account, and typically someone on your HR team or someone else at your company is going to send you the instructions on how to create your account and your login information. Third step, you log into your account and you're gonna pick how much money you want to contribute out of your paychecks. The fourth thing that happens is either your very next paycheck or maybe the one after, sometimes there's a delay, you're gonna see a deduction come out of your paycheck because that money has been sent directly to your retirement account. Fifth step after that, the money in your retirement account is typically invested for you without you having to do anything. And it's typically invested into assets like stocks and bonds, often in the form of funds, which I'm going to talk about a little more later in this video. What this means is you don't have to pick what to invest in. You don't have to go in and click anything. It makes it really easy for a beginner who is just starting to invest. Now, the caveat with this type of investing, meaning putting money in a retirement account, is that you can't touch the money without a penalty until retirement age, which is 59 and a half. Keep in mind that if you do take money out of these accounts before 59 and a half, you can have penalties that have the potential to wipe out some of your gains or all of your gains. So why then do people invest in retirement accounts? There are 2 primary reasons that these accounts are favorable, why people like them. Number 1, if you get an employer match as a benefit from your job, some people consider that to be free money. For example, if they match your contributions dollar for dollar, that's a 100% gain or return on your investment. You put $1, then you get $1 from them. Obviously, you can't touch it until retirement age, but you didn't have to do much to earn that dollar. And number two, these accounts are pre-tax, which simply mean that any money you contribute to them are not going to be taxed the year that you contribute it. So if you put money in this year, it's going to lower your income tax liability for this year. Just note that this only defers taxes until you take the money out during retirement. It doesn't mean you avoid taxes forever, but it does help your tax situation now, which is a nice benefit. At the end of the day, I think you should consider investing in both retirement accounts as well as non-retirement accounts, because chances are you probably have financial goals that are going to require using that money before you're 59 and a half. And especially if you want to retire early, then you got to start investing outside of retirement as well. All right, method number 2 for investing, especially if you don't have the option of a 401k or 403b or any kind of employer-sponsored plan, using a robo-advisor. You can invest as a beginner with a small amount like $300 by opening an account with a robo-advisor platform. Robo-advisors are online tools that use technology to build and manage your investments automatically. What this means is you wouldn't have to select your own investments. You're basically putting money into an account and they're investing it for you. So you can think of them as like financial robots that are making those decisions for you. There are many financial companies out there that either operate solely as a robo-advisor platform or that offer the option to invest in an account that is run by a robo-advisor. Now, the main benefits with robo-advisors is they are cheaper than working with a traditional human advisor, like working with a person, and there's typically a low or even no barrier to entry, which means you can invest with a small amount of money. Here's how it works step by step. Number 1, you're gonna have to find a robo-advisor platform online. Now, here are some examples for educational purposes only. I just want you to have an idea of what it is I'm talking about. So Wealthfront, Betterment, Vanguard Digital Advisor, and SoFi Automated Investing are some popular examples. Now, keep in mind, this is not a sponsored video, and I don't have personal experience with all of these, but I want you to know what I'm talking about when you start doing your own research. Step number 2, you are going to create an account with one of these companies by providing your personal information. That's going to include your name, address, and all that stuff, and also your social security number. Number 3, you're typically going to be asked to answer a brief questionnaire to understand your investing goals and your risk tolerance. Number 4, they're typically going to have you connect a bank account so that you can transfer funds that are going to be invested. You can usually set up a recurring transfer, or right now, since it's your first time, you can even just manually do a one-time transfer. And then step number 5, the robo-advisor builds a portfolio for you using its algorithms and its data based on those questions that you answered, and then it invests your money. So robo-advisors are a great option for beginners or anyone who wants a simple automated way to invest. A downside is obviously you don't have a human advisor who's going to actually look at your finances and help you pick your strategy, but it is one easy way to get in with a little bit of money and when you're just getting started. All right. The third and last method I'm going to talk about in this video to get started investing is the DIY method. This means opening your own taxable brokerage account. So the biggest benefit to doing it all yourself is that there are no advisor fees. Because you're selecting and managing your own investments, you're not going to be paying a human advisor and you're not going to be paying a robo-advisor. Now, before you freak out thinking, how am I going to possibly select what investments to buy? Let me introduce you to the concept of funds. Funds are essentially baskets of securities that you can buy all at once. This means instead of buying a stock from one company or buying one bond, you're going to own many securities at once. So it's like having shares from a whole bunch of different companies all in one go. Buying funds are a quick and easy way to ensure that you're diversified. This means that you have your money spread out across different assets, different companies, and even different industry sectors. The more diversified you are, you typically have lower risk. There's lower risk of losing your money because if you put your money into one individual stock and one company and that company just goes out of business, then you are shit out of luck. When you have your money in 500 companies and one goes out of business, you'll still have those other 499 companies. Now, there are a lot of different ways to invest in funds, but a popular way for beginners is to invest in index funds. You can think of it like a pre-made list of companies. So you might have heard of the S&P 500. The S&P 500 is essentially a list of 500 of the largest companies in the United States. There are a lot of different indices, which is plural for index, which means there are a lot of different types of index funds. The S&P 500 index funds are only one example. Now, there are two main ways to buy these funds, such as index funds, that I just mentioned. One, you can purchase mutual funds, but that's not the topic of this video. Typically, most mutual funds require more money than just starting with $300. So instead, one way to do it as a beginner with just a few $100 is to purchase exchange traded funds, aka ETFs. The way these work is the same manner in which you would buy an individual stock. So step by step, here's how you can buy an ETF to make your first investment with $300. Step number one, find a brokerage where you can open a brokerage account. So there are a lot of examples out there, but again, for the sake of education, so I'm not just making stuff up out of thin air, I want you to know what I'm talking about. Examples are Fidelity, Vanguard, Charles Schwab, etc. Now, here is an important piece of guidance if you only have a small amount to invest with, like $300. Make sure you choose an account from a company that allows you to purchase fractional shares of ETFs. You can find this out with a simple Google search or when you're looking at the website of whichever brokerage you've picked. Step number two, once you've selected a brokerage, open an individual brokerage account. You're going to use your personal information, including your social security number, very similar to if you're opening an account with a robo-advisor. And just so you know, sometimes it might be called a taxable brokerage account or just brokerage account. Just make sure it's not like a retirement account or something. Just have to point that out because it should be differentiated from a retirement account or other types of accounts. All right, step number three, based on which brokerage you pick, once you're logged in, it's going to vary on how it looks like. But what you want to do is to try and find the option where you can research securities like stocks or ETFs. Now, it's going to look different based on brokerage accounts and different companies, but I want to show you this part in my Schwab account just so you can see what it looks like. Step number four, search for an ETF that represents a broad index. Remember, buying index funds is about buying this pre-made basket of securities. There are ETFs or exchange traded funds that contain many companies within them based on different things. There could be an energy sector ETF. There could be a beauty supply ETF. And as a reminder, like I mentioned earlier, a popular index that people like to buy is the S&P 500 because these are the top 500 companies in the United States. So once you've decided which fund you want to buy, step number five, you're going to select that ETF and enter how much you would like to purchase. At this point, again, the screen might look different depending on which brokerage you've picked, but there's going to be a buy button.
I want to walk you through this purchase screen, even if yours will have a different interface depending on which brokerage you ended up picking. Now, real quick disclaimer, I use Charles Schwab for my own self-directed investments or my DIY investments, but just take note that they don't technically offer fractional shares of ETFs, which I suggested earlier in the video, especially if you're starting with a smaller amount. Now for action, the selection to buy is pretty straightforward. Your goal as a beginner is to purchase and acquire assets, not to sell or short sell, so don't worry about any other options. Now before you do anything else, as a beginner, I suggest you select market as your order type. For the purposes of making your first investment, it is the simplest type of order. What it means is that when you hit buy, your transaction will probably be processed. Think of it like the buy it now button on eBay. So instead of bidding a price for the item, you want it now, they're offering it now, and you can purchase it. Quick reminder overall that when you are buying an asset, such as a stock or an ETF, someone else has to be selling it. When you choose market order, aka the buy it now option, you're telling your broker that you are down to buy it at whatever the current going rate is. So your broker is the company where you opened this brokerage account. Now, since I'm on the eBay example, let's say you want an item, but only want it for a specific price. You don't want to pay more than this certain price. Instead of the buy it now button, you would want to bid on it. meaning you want to put a price amount that you want to buy it at. This is essentially how a limit order works. But that's beyond the scope of the video. I just wanted to explain that there are different ways to purchase assets. Long story short, pick market order if this is your first investment. Now, finally, choose your quantity. So like I said, this Schwab account doesn't actually let me purchase fractional shares, but if yours does, then you can change the quantity and it'll update the cost and you'll know how much you're going to buy. Now, if you have an option to reinvest dividends, like my screen says, that's going to be up to you, and you might want to consult a tax professional. If your goal is to have your money and investments compound over time, then you might want to consider reinvesting your dividends, but you have to make sure you understand how this impacts your taxes, because dividends do count as income. You can hit review, and then it'll take you to a screen where you can finalize the order, and it'll say something like place order or buy.
Now, once you hit buy and your order is filled, you'll be able to go into your investment account when you're logged in and see all of the assets you own. Just like that, owning an asset means you're an investor. Now, if you chose this third option and you're actually investing completely on your own, I'm sure that can be scary, so congratulations. That is a huge step towards financial security and building wealth. So I know this was a long video, but I hope that it helped you feel a little more confident about making your first investment. And if not, ask me your questions in the comments. I will do my best to answer, or I'll even make videos if I get a lot of the same frequently asked questions. Don't worry, I got you. Start investing, and until next time, peace out.